Financial market is a broad term used to describe any forum where buyers and sellers meet to trade assets, usually financial securities such as stocks, bonds, currencies, options, and derivatives. Financial markets are a cornerstone of a capitalistic economy because they help facilitate capital formation and liquidity for entrepreneurs and businesses. Financial markets create liquidity by making it easy for buyers and sellers to trade their financial holdings. Without the infrastructure of a market, sellers would have to seek individual buyers using less efficient methods such as classified ads, much in the same way someone sells a used car. In addition, the centralized location provides transparency for price and availability and better subjects the securities to market forces of supply and demand. This in turn assures buyers and sellers of a fairer price than they might otherwise receive in a single private transaction. Because they are subject to supply and demand forces, financial markets sometimes experience wide volatility due to variables such as the unemployment rate, gross domestic product, and housing prices. In the 20th century and before, financial markets were central locations where traders met and made trades in face-to-face transactions. The New York Stock Exchange is one of the oldest and most famous financial markets in the world that still has face-to-face trading. Other financial markets, like the Nasdaq, lack a physical trading location. Instead, trades are facilitated via an electronic system. Capital markets channel savings and investments between suppliers of capital, such as retail investors and institutional investors, to users of capital like businesses, governments, and individuals. They do this by selling financial products like equity and debt securities. Equity securities, also called stocks, are ownership shares in an organization. Debt securities, such as bonds, are interest-bearing IOUs. Capital markets include primary markets and secondary markets. In primary markets, new stock and bond issues are directly allocated to institutions, businesses, or individual investors. In secondary markets, existing securities are traded in organized and often regulated markets like the NYSE or Nasdaq. Capital markets are concentrated in financial centers such as New York, London, Singapore, and Hong Kong. Because capital markets move money from people who have it to organizations that need it for productive uses, they are critical to the effective functioning of a modern economy. TV Tech is a startup company that is looking for investors to fund their new product, a combination TV and watch device. Alice, a venture capitalist, believes this new company will be a great success and decides to buy 20% of the startup directly from the founders. This transaction, because it lacks a regulated market, would take place in the primary market. If TV Tech then goes public and is listed in an exchange like the NYSE or the Nasdaq, then buying and selling shares of TV Tech from its original investors would take place in the secondary market. Money markets are safe, liquid investments that are well suited to the small investor. They typically invest in steady funds, such as treasury bills and commercial paper. George is a recent college graduate who wants to save up for a trip to Europe in 12 months. Because his time horizon is short, he chooses to invest his savings in a money market fund. Money market funds are short-term, so funds are invested for a limited period of time. Treasury funds and commercial paper funds last an average of 1 year or less and 270 days, respectively. If George needs his money from one of these accounts before the investment time has ended, many money market funds offer the option of selling the fund, usually for a smaller profit than if the money had stayed in the account until the term ended. Opening a money market account is as simple as opening a savings account with a few differences. The account usually requires a minimum balance to open and be maintained at, and you must leave your money in the account for a specific time period. While money market funds do not yield a huge return, they boast higher interest rates than most savings accounts and are more convenient for short-term investors. A stock market is where shares in corporations are issued and traded. Stock markets are key components of a free market economy. Stock markets serve two main functions. From the company perspective, stock markets provide access to capital, usually in the form of cash. If a company needs to finance a major project, it can sell its shares in the stock market to raise capital instead of borrowing the money from a bank. From the shareholder perspective, the stock market provides a way to participate in a company's growth and also quickly convert shares into cash. This happens in two main ways. In a privately held company, stockholders are usually comprised of founders and initial investors who can sell their shares on the stock market exchange and reap the reward for the risk they took in creating and growing their business venture. This is referred to as the primary market. For investors who own shares in publicly traded companies, the stock market allows them to participate in the growth of a company without taking the risk of starting a company themselves. This is referred to as the secondary market. The two main stock markets in the United States are the New York Stock Exchange, NYSE, and the NASDAQ. Foreign stock exchanges include London Stock Exchange, Hong Kong Stock Exchange, Euronext, and Deutsche Börse. In the early days of the stock markets, stocks were traded on the floor of the exchange person to person. Now almost all stock trades are done electronically.